Just a few weeks ago, there was absolute panic in the stock market. If you opened your portfolio, everything was bleeding red. The S&P 500 was dropping. Elite technology stocks were getting crushed. The financial news was screaming about geopolitical escalations in the Middle East, a massive spike in crude oil, and the terrifying return of inflation. Every single headline was designed to make you feel like the global economy was on the edge of a total collapse. And the natural human instinct for millions of retail investors was to hit the sell button. They wanted to stop the bleeding. They wanted to move their money into cash, wait for the dust to settle, and maybe buy back in when the market felt safe again. But if you watch this channel, you know I was opposed to that. During the absolute worst days of that crash, I published a video telling you that I was ignoring the fear. I told you that the market was reacting to temporary geopolitical noise, not a structural economic failure. And I told you that I was deploying my cash to buy the dip on some of the highest quality businesses in the world. And today, we can see exactly why. The stock market just pulled off a massive, violent V-shaped recovery. The major indices have erased almost all of their recent losses. The extreme fear that was dominating Wall Street has completely vanished. In this video, I'm going to break down exactly why this explosive recovery happened so quickly. I'm going to explain the brutal financial lesson that panic sellers just learned the hard way. And most importantly, I'm going to share exactly what my strategy is right now that the market is back at the top. Welcome back to Rebuild Finance. This channel is about documenting a real journey to a $1 million portfolio. If you want to learn how to build long-term wealth without letting fear dictate your decisions, make sure to subscribe. Let's step away from the headlines and look at the actual mechanics of this recovery. To understand why the market bounced back so aggressively, you have to understand the difference between a geopolitical shock and a fundamental economic crisis. A fundamental crisis is something like the 2008 housing collapse. That is when the actual banking system breaks, credit freezes, and businesses go bankrupt. That takes years to recover from. But what we experienced in April 2026 was a classic geopolitical shock. The market was terrified of the conflict between the United States and Iran. Wall Street algorithms hate uncertainty. They cannot calculate the probability of a war, so they default to the safest option. They sell aggressively. They were pricing in the absolute worst case scenario. They assumed oil prices were going to stay permanently elevated, which would cause shipping and manufacturing costs to explode. That would lead to a massive spike in inflation, which would force the Federal Reserve to completely abandon their plans to cut interest rates. But here's the reality of the stock market. It overreacts to the downside, and it has a very short memory. As the days passed, the catastrophic scenarios did not materialize. The conflict was contained. The global supply chain did not freeze. And as soon as the worst case scenario was taken off the table, crude oil prices began to stabilize. The moment oil stabilized, the inflation fear vanished. The moment the inflation fear vanished, Wall Street realized the Federal Reserve was not trapped. The algorithms that were aggressively shorting the market suddenly had to reverse their positions. And when billions of dollars of institutional money flood back into the market all at once, you get the massive, violent V-shaped recovery that we just witnessed. And this brings us to the most brutal lesson of this entire market cycle. During the crash, millions of retail investors made the ultimate mistake. They sold their assets and moved to cash, telling themselves they would just wait for the dust to settle. They wanted to see positive news before putting their money back to work. But here is the devastating reality of the stock market. By the time the dust settles, and by the time the news is positive, the market has already recovered. The stock market is a forward-looking pricing engine. It does not wait for an official peace treaty. It does not wait for a perfect economic report. It prices in the recovery weeks before the general public feels safe. If you sat in cash waiting for a green light, you completely missed the explosive bounce. Historically, the absolute best days in the stock market almost always occur within 2 weeks of the absolute worst days. If you miss those few explosive days of recovery, your long-term returns are permanently crippled. The people who panic sold a few weeks ago are now trapped. They are watching the market rally without them. And if they want to get back in, they have to buy their exact same shares back at a much higher price than they sold them for. They literally destroyed their own wealth simply because they let a temporary emotional headline override their logical investment strategy. On this channel, we refuse to play that game. We recognize that elite businesses were going on sale for reasons that had nothing to do with their actual ability to generate cash. And that is the second major reason the market recovered so fast: corporate earnings. While retail investors were hyper-focused on the political news, Wall Street started looking at the actual balance sheets and income statements. Because right in the middle of this geopolitical panic, earnings season kicked off. As we discussed in my last video about Netflix, despite all the macroeconomic fear, these companies are still cash flow machines. A conflict on the other side of the world does not stop hundreds of millions of people from paying their monthly streaming subscriptions. It does not stop millions of small businesses from buying advertising on Meta. It does not stop massive enterprises from paying for Amazon Web Services and cloud computing. The underlying businesses were never broken. Wall Street looked at the massive free cash flow, the expanding operating margins, and the incredible balance sheets of these elite companies, and they realized that selling them during a temporary geopolitical panic was a massive mistake. The intrinsic value of these monopolies was actually growing, even while their stock prices were dropping. That divergence between price and value is the definition of an investment opportunity, and it is exactly why I aggressively added to my positions during the crash. So, the market has recovered. The panic is over and stock prices are back near their highs. What is the plan now? Do I take my quick profits and sell? Absolutely not. I am not a swing trader trying to time short-term cycles. My goal is to build a $1 million portfolio, which means I am playing a multiple-year compounding game. My strategy today reverts back to being incredibly boring, but incredibly effective. During the crash, I broke my standard rules and deployed extra cash to take advantage of the artificial discounts. I accelerated my buying because the market gave me a rare gift. But now that the discounts have vanished and the market is pricing these companies fairly again, I am simply returning to my standard dollar cost averaging strategy, and my philosophy remains always be buying, or ABB for friends. I will continue to inject a set amount of capital into stocks every single month, regardless of whether the market is up or down. I am holding my winners, I am letting their massive free cash flow compound over time, and I'm actively researching new, high-quality businesses to add to my watch list for the next inevitable market drop. I am not chasing hype, I am not giving in to the fear of missing out, and I am certainly not selling my best assets just because they had a good week. If there is one thing you take away from this market cycle, let it be this: volatility is the price of admission in the stock market. There will always be another scary headline. There will always be a new geopolitical crisis, an inflation warning, or a media personality telling you that a massive recession is guaranteed. Wall Street algorithms will use that fear to shake you out of your positions. But if you zoom out the trajectory of human progress, corporate innovation, and global markets is consistently up and to the right. The investors who panic sold a month ago paid a brutal tax for their fear. The investors who held strong, trusted the math, and bought the dip are the ones who are heavily rewarded today. Now, I want to hear from you. Be honest. Did you hold strong and buy the dip during the recent crash, or did the massive volatility shake you out into cash? Let me know in the comments down below. I read and respond to every single one. If you found this video helpful, please hit the like button and subscribe. It really helps the YouTube algorithm push this video to more long-term investors. And if you want to see exactly how I broke down the recent Netflix earnings report and why I use that specific drop to buy more shares, make sure to click the video on your screen right now. Thanks for watching, and I will see you in the next one.